Hello. Today, let us look at provision for bad debts. Okay. So some will use the word allowance, which is the same allowance for bad debt. Okay. And because bad debt is the same as irrecoverable debt, it is also the same thing to say provision for irrecoverable debt. Okay. In IFRS, you'll find allowance for expected credit losses, but the concept is the same. Okay. And basically, what this means is being able to provide for bad debts or creating an allowance in our books at the end of the period for bad debts. That is, debts that will not be collected. So basically, what we do an estimate of the amount of receivables that may become uncollectible in future, and make sure we do adjusting entries during the end period. Okay, to record this provision that we have made. Okay, so how do businesses arrive at this estimate? One is a percentage of the receivable. So they look at the previous period, they see, okay, so defaulting, the receivables that have been defaulted is this amount over these receivables. So they can be able to estimate that for this period, we can maybe have 3% or 4%, depending on what we have seen before. Then we also have aging of receivables, which is the same thing, but here we have the concept of the period. We are going to look at examples to understand what do we mean by that. Okay, so the first example is, we are told KM Traders Limited made trade receivables of amount 200,000 at the end of year 2025. Based on past experience, management estimated 5% of receivables may not be collected. First, what do? We calculate the provision that we need to make during the end of this period 2025, which is 5% of 200,000. Okay, which is going to be 10,000. Okay, so what we are saying is 5% of these receivables, that is 10,000 out of 200,000, might end up being bad debt. So it will end up being a loss. And we need as per the prudence accounting principle, which states we should not overstate our assets, and also we should not overstate our income. So if we can predict a loss in the future for this accounting period, we need to make sure we account for that loss. And this loss is basically, we did give out goods or services on credit, and we have this we have seen there is a track record of this amount being defaulted, or rather not being paid. So this is a loss that we need to recognize for the end period, 31st December 2025, which is 10,000. So at the end of the period, which adjusting entries do we pass to record this? What we do is we debit what we call a bad debt expense account, which is basically an expense account, because this is an expense to the business. Selling something and not being able to pay, them not being able to pay you, it's going to be an expense, it's going to be a cost. Okay, so which we ensure we record this in our bad debt expense account. Okay, and as we pass this entry, I want us to note this. We are going to credit first. Let us credit this account, which is provision for bad debt. As mentioned, you're going to find others are going to say allowance for bad debt, which is the same thing. Okay, so provision for bad debt account, you're going to credit 10,000. Okay, let's talk about this account. This account is a contra asset. Account. What does that mean? It reduces the asset account that it relates to. In this case, it relates to our account receivable. So it usually reduces the account receivable account. Okay, so it reduces our receivables. Our receivables are usually current assets. So when we provide for this bad debt of 10,000, we ensure we have reduced our receivable as at 31st December 2025 by 10,000, because we have this prediction that this 10,000 may not be collected in future. So because these receivables are as at 31st December 2025, we can say 200,000 represent a fair a representation of our receivables. No, we need to less this 10,000. So provision for bad debt is a contra asset account, and we pass this only when we know our balance for provision for bad debt account is 0. I'm going to go, when we do the second example, you will understand why I've said when the balance is 0, because we do the adjusting entry depending on the balance we have for this provision for bad debt account, okay? So how will this affect our balance sheet? So where we have the current asset, because our account receivable is a current asset, okay? So we're going to have receivables here, account receivables, an amount of, here we are looking at the balance sheet. We are looking at our balance sheet, okay? So this is the balance sheet. I'm just looking at the section where we usually have the current asset. So we will have our 200,000, and then we are going to come and less. We are going to come and less this allowance for bad debt, okay, which is 10,000. So we will note that our during the as at 31st December 2025, when looking at these two aspects only, we're going to have a balance of 190,000 for our receivables, not 200,000, 190,000. That is why I say this is a contra asset account. It reduces the asset account it relates to, okay? So what happens to our P&L, our statement of profit and loss, where we usually have our revenues, all right? We have revenue, then we have expenses. We list our expenses here. We have to ensure we also are including our bad debt expense here, okay? Which in this case is 10,000, okay? So when we are deducting our revenue, less the expenses, we make sure we also less the bad debt expense, okay? So this is basically being able to provide for this loss that may occur in the future, okay, from what we have recorded during this period, okay? So let us look at the second example, which is a practical example of now aging, okay? So we are told here, Nawe Limited trade receivable aging schedule as at 31st December 2025 was as follows. So this is what we call an aging schedule, and it requires you to state the receivables depending on the period that they have lapsed as a receivable, okay? So if we have receivables that have only lapsed from period 0 to 30, we have it's 120,000, and because they have not stayed for long, the probability of them being defaulted is lower. That is why we are using a 2%. But here, when we have over 60 days, okay, the percentage is higher. Why? Because the longer a receivable stays without being paid, the more it is likely not to be collected, okay? So that is how we use the aging receivable method, okay? So here we are told, we have additional information where we are told the opening balance for provision for bad debt account as at 31st, as 1st January 2025 was 10,000, okay? And in March 2025, a customer owing Kenyan shillings 3,000 was declared bankrupt. So this is what I want to show you by what happens when we have an opening balance, and we have how do we do also a write-off. But first, as at 31st December, this is our aging schedule. Let's first calculate the provision we should make as at 31st December 2025, which will be basically 2%, okay, multiplied by 120 plus this as well. We do for all of the three of them. So this is basically means we do 2%. 2% of 120,000, which is 2,400, okay? Then we have the second one is 5%. The second one is 5% of 50,000. So 5% of 50,000 is going to be 2,500. And then the other one is going to be 10% of 30,000, which is going to be 3,000. Then when we sum this, we're going to have a total of 7,900. So as at 31st December 2025, we need to have an allowance of 7,900. But first, I want to show you something. I want us to have a pictorial, or rather a representation of this account we are referring to as allowance, a provision for our bad debts. Okay, so here it's basically, this is the allowance for bad debt account. Okay, so we have debit, we have credit here. We are told we have an opening balance of 10,000, okay, in this account as at that 1st January 2025. And then we are told in March 2025, a customer owing 3,000 was declared bankrupt, okay? So that means they are not going to pay us. So we need to write off this receivable of 3,000. How do we go about it? We come and debit now this allowance to reduce it. What does that mean? We want to know that we have used 3,000 from our allowance for bad debt. Okay, from what we had provided for 10,000, we have used 3,000 in writing off this receivable, which is 3,000. Okay. On the other end, it is no longer a receivable because now we have confirmed it's not going to be paid. So we credit the receivable account, okay, by 3,000. So in this account, you're going to have a debit on this side of allowance for bad debt account. So as at end of March 2025, what will be our balance? Our balance will be 10,000 less 3,000. We're going to have a credit balance of 7,000. Now we are looking as at 31st December 2025. Now the period end. What entries should we pass so that during the end of that, at the end of that period, our allowance for bad debt account should have 7,900. From what we calculated, we need to have a provision of 7,900. And recall, our balance is 7,000 as at end of March 2025. What do? We take 7,900, we deduct 7,000. So we only need to make a credit. Adjustment of 900. So how are we going to, as at year end, what will be the adjusting entry as at year end to make this provision so that our account balance is 7,900? We need to come and debit bad debt expense account, an amount of 900, okay? And do what? And credit allowance for bad debt, an amount of bad debt account, an amount of 900. Why are we doing so? We are doing so because we only need a balance, or rather our balance as at 31st December 2025, our provision to be 7,900. So we are not coming here to make a credit of 7,900 because this is wrong, because we will end up having a provision of 14,900, which is not the case. The only provision we need is 7,900. So we have to look at our balance, the balance of that account that is remaining. Okay, the balance that we have in that account that is remaining. And then we calculate the provision we need to make as at that specific time. Then we see which adjustment should we do. In our case, you've seen we will only need to add 900. That is why we are passing this. Unlike the previous example where I mentioned, our assumption here is our balance is 0. So we have to make sure we credit 10,000 to make sure as at year end we have that provision of 10,000. You see now our account balance is 7,900 because you have only passed a journal entry to add 900. Okay, then let us look how will our balance sheet look like. That is the statement of financial position under the current asset. That is the account receivable. Our account receivable will basically have 200,000. I've just calculated a total of, this is 120,000 plus 50,000 plus 30,000, which will give us which will give us 300,000. So I'm just doing a snippet of the balance sheet, okay? On this section, you see how this how it affects our financial statements, okay? So as mentioned, this allowance or for bad debt, or rather provision for bad debt, it is a contra asset account. So it reduces the asset account that it relates to. So here we are listing this allowance for bad debt account. Allowance for bad debt account. Okay, so an amount of our balance as at year end is 7,900. Remember, in the balance sheet, what do we look at? We look at the account balances. So we are lessing 7,900. So it is going to be basically 3,000 less 7,900. That is going to be now our new account receivables. Okay, so on the other end, on the P&L, as mentioned, we usually do revenue less expenses. That is when we get the income, okay, or rather the profit. Okay, so we should make sure we record our bad debt expense. In this case, it will be 900. Our bad debt expense during the period is 900, because don't forget, if you are looking in the previous period, let's say for example in this period we had a bad debt of expense of 10,000. Even in this period, because our opening balance was 10,000, we had recorded a bad debt expense of 10,000. So here we are only looking at the bad debt expense during the period. So we are not passing here 7,900. In fact, that is not the entry we made. Our bad debt expense is 900, which is the expense we have incurred during the period. Okay, so we make sure we less this as usual. When we are lessing, we are doing the revenue and less the expenses. So this is basically one of the examples of method of how we arrive at this estimate, and how we go about at making the adjusting entries. Okay, this is a very simple concept. Okay, so we are going to do many more examples till we get to understand this concept. Okay.